The global NASDAQ 100 covered call ETF, known as QYLD, is an exchange-traded fund that aims to provide investors with income from a covered call strategy on the NASDAQ 100 index. Now, the NASDAQ 100 index is a benchmark index that tracks the performance of the 100 largest domestic and international non-financial companies listed on the NASDAQ stock market based on market capitalization. The QYLD ETF buys shares of the NASDAQ 100 and sells call options on a portion of these shares in order to generate income from the premiums received from selling the options. The covered call strategy involves selling call options on an underlying asset. In this case, the shares of the NASDAQ 100 index are the underlying asset. Call options give the buyer the right but not the obligation to buy the underlying asset at a specific price, and this is known as a strike price, within a certain time frame or by the expiration date. And in exchange for selling these call options, QYLD ETF receives a premium payment from the option buyer, which then is hopefully transferred over to the QYLD shareholders. Now let's talk about how the QYLD dividend is generated. The income generated from selling call options is distributed to the investors on a monthly basis as a form of dividends for QYLD. The dividend amount is determined by the premiums received from selling the call options, less any expenses incurred by the fund, such as management fees. So in theory, throughout a market where there's more volatility in general, option premiums are going to be more expensive. And therefore, in theory, when there's more volatility, the shareholders of covered call funds like QYLD should be receiving bigger dividends. Again, in theory. Now, one potential benefit for QYLD ETF's covered call strategy is that it can provide some downside protection in a volatile market. If the price of NASDAQ 100 index declines, the premiums that QYLD received from selling the call options can help offset some of the losses. And this is why sometimes you'll see QYLD may be down less than the regular market. But there is a downside to this strategy. The QYLD covered call strategy can limit the fund's potential gains in a rising market. So if the market decides to rip and really move upwards, the fund is going to be sort of capped on the gains it can receive. Now, full disclosure, before we move any further in this video, I currently do own around 2,000 shares of QYLD throughout my multiple portfolios, and I've been holding on to most of these shares for years now. I haven't bought that many more QYLD shares in the past year or so, but years back I was buying QYLD like crazy, and I am down on my shares actually. And in this video, we are going to keep digging deeper into QYLD. And as of April of 2023, and see, is QYLD still worth buying? Is QYLD the ETF that you should stay away from? And lastly, do I regret buying my shares of QYLD long ago? So let's first go over some of the basics when it comes to QYLD and just get a baseline of where things are at. So currently QYLD is actually up as of recently. It's trading in the low $17 range, but on the max chart, QYLD is down over 32% as of all time. Now, a few years back when I was buying QYLD like crazy, it was trading pretty consistently in the low 20s. And to be honest with you, I figured that it was most likely going to keep trading in that range for quite some time because a covered call strategy fund like this, for the most part, shouldn't necessarily have all that much volatility because, again, during up markets, the profit is capped but does move up. And during down markets, the downside protection kicks in because of the premium received from the covered call strategy. But ever since towards the end of 2021, QYLD has sort of fell off a cliff, dropping down below 20, down below 19, down below 18, and even as of the recent low, the 52-week range, $15. That is a very, very low price for a fund that should have sort of a maintained volatility aspect. Now, moving over here on the actual QYLD Global X website, let's take a look at some more facts. As of right now, the trailing 12-month dividend yield is 12.87%. Now, this is the distribution yield an investor would have received if they had held the fund over the past 12 months, assuming their most recent NAV. The 12-month trailing yield is calculated by summing up any income, capital gains, and return of capital over the past 12 months. So this is interesting because just a few months back, the trailing 12-month yield was, I think, in the 15-16%. So right there, you're seeing that the trailing 12-month yield, basically the historical yield over the last year, has been dropping consistently. On top of that, the distribution yield moving forward, as long as nothing else were to change, is even lower than that, at 11.64%. Now, don't get me wrong, 11.64%, 12%, anything around there is quite impressive for a yearly dividend yield. But when you're buying into a fund that's going to mostly trade sideways and or even decay, as we've seen over the past few years, you're going to want to at least have a steady, if not increasing, 12-month trailing dividend yield. Another important fact about this fund is that the net assets is $7.01 billion. So although it's not the largest ETF out there, it is a pretty big size. Some facts on the holdings of QYLD. You can see right here, this is the option position. It has a short NASDAQ call option. This is the cover call and all the information right here. Now the top holdings are the top holdings of the NASDAQ 100 index, so nothing really too surprising there. But again, one thing that's been quite disappointing as far as QYLD goes is the fact that the distribution, the dividends have been dropping pretty significantly over the past year. Let's next talk a little bit about who would be a good investor for something like QYLD and why the heck did I buy so many shares of QYLD. So I'll start with me first. I personally bought a lot of shares of QYLD back a while ago because I did think that the income and risk averse nature of the fund would be a good balance to my portfolio, because currently I do have a lot of growth oriented investments in my overall investment portfolio. Now, sort of trying to balance everything out, I figured that having something like QYLD that could pay me a consistent dividend every single month and hopefully at least trade sideways, it would sort of balance alongside of my much more growth heavy, lower cash flowing assets. But for the most part, the characteristics of someone that would want to invest in something like QYLD would most likely be income focused investors. Also people that are risk averse, although the downside protection hasn't really been kicking in all that great if you ask me. And of course, investors seeking diversification like myself. Because when you are investing to QYLD, you aren't investing into a single name stock. It's obviously an ETF. If you were to ask me, this is probably the most disappointing part of all when it comes to QYLD. Now, over the last almost 2,000 days, a 5-year time frame, QYLD has returned a total return of just 30.61%. Now, that's not absolutely horrible considering the markets that we've been through over the past few years. But with the massive dividends month after month, the fund really has to decay in order to return such little. Especially when you compare it to something like abbvie that's returned 41.33% over the past 5 years, which again isn't that much higher, but abbvie also has not even been around for 5 full years. And of course, during this 5-year time frame, if you would have just invested money into the S&P 500 and not chased after those high dividends, you would have had a total return of 71.18%. Now, this simply goes to show that those investors out there that are chasing after yield, those investors out there that are chasing after income, like myself to be honest, because I do own a large amount of QYLD and abbvie, those investors out there that chase after these type of funds can find themselves in the position like this. Staring at the chart where you can see in a certain time frame, in multiple time frames actually, you would have been better off just buying into the S&P 500. So overall, what do I think about QYLD from here? And is it something that I'm going to sell off in my portfolio? And is it something that I'm going to buy more of in the future? The easy part of the answer is that I will not be buying more QYLD anytime soon here for the most part. Although it does seem to be stabilizing out a little bit now that the market's sort of bouncing back up, it could seem tempting for investors to want to grab some more shares of QYLD. But from what I've seen holding on to QYLD now for several years, it's not really doing exactly what I thought it was going to do. And I would rather even invest in things like abbvie or abbq if I was looking for a higher income fund. But on the same token, I'm not going to be selling off any of my QYLD. I'm going to hold on to it. And even though during the time frame that I've been holding on to QYLD personally, the fund has decayed quite a bit, I know that with the dividends paid out, the total return isn't all that horrible. But I want to hear from you guys down below. Is QYLD something that in 2023 you would consider buying? And if so, let us know why. If you enjoyed this video and you want to see more videos like this, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.